What we'll be doing in this lecture is, first we'll be revising all the concepts of capital structure. Then we'll start with solving some of the questions of capital structure. So we started with capital structure decision making. What is capital structure decision? If in my company 100 crore rupees is required, I will borrow either from debt or from equity or from combination of debt and equity. Higher the debt, higher is the risk. What should be the proportion of debt and equity? 80-20%. If I decide I am taking capital structure decision. What is capital structure decision? Deciding proportion between debt and equity is capital structure decision. Second point was, when we are taking capital structure decision, what should be our objective? And it should be overall objective of finance, which is maximizing shareholders' wealth. And in short, we can say maximizing market price of share. In some of the companies, MPS might not be available. They might not be listed in the market. And so it can also be maximizing earning per share. This is objective of taking decision making. What does it mean? If a question of capital structure is asked, I'll find out MPS under both the capital structure. Higher the MPS, I'll be taking the decision. If MPS is not available, higher the EPS, that decision I'll be taking out of the options of capital structures which are available. Third is, we understood the profitability statement. In finance, especially in capital structure, we start with EBIT, which is nothing but operating income. We deduct interest from it. I will be getting answer of EBT, earning before tax. We reduce the tax from it. I will be getting earning after tax. As a preference is not a deductible expenditure for tax purposes, I will then deduct preference dividend after deducting tax. I will be getting earnings available to equity shareholders. Once I get earnings available to equity shareholders, I can find out EPS by earnings available to equity shareholders divided by number of shares. And if PE ratio is given, what is PE ratio? Very simple. It compares market price per share upon earning per share with earning per share. So if say PE ratio is given, I can find out MPS by EPS going this side, EPS multiplied by PE ratio. This is profitability statement. Then we understood how to take a capital structure decision. And the concept was leverage effect or trading on equity. We have already understood the concept of KD in cost of capital, but here KD is pre-tax cost of debt. See what does leverage effect says? It says if you increase the debt proportion, not debt, if you increase the debt proportion in your capital structure, your overall cost will reduce and your value of a firm, that is MPS or EPS or total value of the firm, will increase. But we have understood this happens only and only if R. Now what is R? R is nothing but return on capital employed. How it is found out? It is EBIT upon capital employed. If I am earning EBIT of 10 rupees and my total capital employed is 100 rupees, R is 10%. Only if R is greater than KD, then there is a favorable leverage. What does favorable leverage means? The risk is favorable on your side. So you take more risk. If R is greater than KD, you should increase the debt proportion. And we have understood, we can directly take the decision if preference shares are not involved, only equity and debt is involved. If R is greater than KD, go for more risky firm. More risky capital structure, having higher debt. More risky is having higher debt. If R is less than KD, go for less risky firm, having less debt. If R is equal to KD, you are indifferent. This is what we have learned in leverage effect or trading on equity. Increase the debt proportion in the capital structure to increase the value of the firm. After that, we learned financial break-even point. This is level of EBIT at which EPS is 0. How to find it out? Financial break-even point is equal to interest. If there is no preference dividend, it is always equal to interest plus preference dividend upon 1 minus T. If preference dividend is available, this will be my financial break-even point. Logically, we have understood it in previous session. So my EBIT, and this is my financial break-even point. EBIT below this, I will be having negative EPS. And EBIT above financial break-even point, I will be having positive EPS. This is financial break-even point. Above financial break-even point, I will be earning positive EPS. Below financial break-even point, if my EBIT is in next year or forecasted, I would be earning negative EPS. What is next point was EBIT, EPS in difference point. What is it? It is the level of EBIT at which EPS is equal under two options, under two plans. So if there are two plans, how to find out the level of EBIT at which EPS is equal under both plan? I take EBIT is equal to X. Then for plan 1, I find out EPS. How to find out EPS? Starting from EBIT. What is my EBIT? X minus interest. This is earning before tax into 1 minus T. This is earning after tax minus preference dividend. This is earnings available to equity shareholders divided by N1. That is number of shares of first option. Interest of first option, preference dividend for first option. And then I compare it with plan 2, EPS. How to find out? Same manner. X minus interest of plan 2 into 1 minus T minus preference dividend of plan 2 divided by number of shares of plan 2. What we want? EPS should be equal under both the plan. Equalize this both. Find out X, you will be getting level of EBIT at which EPS is equal under plan 1 and plan 2. So this is EBIT EPS in difference point. So what is a logical understanding for this? For any company, if this is EBIT line in rupees and this is EBIT EPS in difference point, below this you should opt, as far as capital structure is concerned, less risky plan. What is less risky plan? Having lower debt or no debt. And if your forecasted EBIT, your actual EBIT, what your financial manager is suggesting, what would be your EBIT next year, falls under this. It is above EBIT EPS indifference point. You should go for a high risk plan. What is high risk plan? Having higher debt. Trading on equity or leverage effect will be affected to you, and ultimately you will be benefited going into high risky plan as far as capital structure is concerned. This is concept of EBIT EPS indifference point, and this is how we find out EBIT EPS indifference point. After that, we understood some of the capital structures theory. What is capital structure theory? They are given by some experts that those are capital structure decisions you should be taking, and you should be taking it in this manner. First was net income approach. What does net income approach said? Said the same thing. If you increase the debt proportion in your capital structure, your KO will decrease, and so your value of a firm will increase. It assumed that even if you increase the debt proportion, KE remains the same in levered as well as unlevered firm. Which are the basic formulas which can be used in net income, net operating income, and Modigliani Miller? In all the three, we can always use this formula. Value of equity is earnings available to equity shareholders divided by KE. Value of debt is equal to interest divided by KD, and value of firm is equal to EBIT upon K. Also, value of firm is nothing but value of equity plus value of. And by the same formula, you can also find out KE is equal to earnings available to equity shareholders divided by value of equity. And in same manner, you can find out KO by EBIT upon value of. This normally should be used when there are no taxes. Sir, how to find out KO if there are taxes? You should go for cost of capital, find out weighted average cost of capital. How to find out KE? You should go to cost of capital, find out cost of equity. In that case, this should be used normally when there are no taxes. But this can be used at any point of time. So what does net income approach says? It says this, and it is exactly trading on equity. And it will always work whenever R is greater than KD, R is greater than KD. Otherwise, this will not work. Net income approach will not work. So net income approach is equal to trading on equity. The answer is yes. Just the calculation will be having this formulas. We are going to net operating income approach. Net operating income approach. What does it say? If you increase the debt proportion in the capital structure, your cost will reduce. Why? Because KD is less cheaper than KE. KE is more cheaper than more expensive than KD. So as you use the cheaper material, your overall cost should reduce. But your cost will also increase, because once you increase the debt proportion, your risk increases and your KE will also increase. So on one hand, there is decrease in cost, on another hand, there is increase in cost, and hence overall cost will remain same in levered as well as unlevered, and so value of a firm will also remain same. Irrelevance approach. Which type of approach? Irrelevance approach. What does it say? Capital structure decisions are not important for business decision making. You should not concentrate on how much is to be borrowed from debt and how much is to be borrowed from equity, because value of firm ultimately, whether you are levered or unlevered, is going to remain same. This was not net operating income approach. And last but not the least was Modi-Giuliani-Miller approach or approach for decision making. We understood arbitrage effect of Modi-Giuliani-Miller approach, right? If there is a levered firm, there is an unlevered firm. Initially, levered firm will be higher valued. But proved that from levered firm, if you create personal leverage and go to unlevered firm, then you are benefited. So people will go from levered firm. So demand of levered firm will decrease. Price of levered firm will decrease. Unlevered firm demand will increase, price will increase. So this was the situation. Levered firm price was higher, unlevered firm price was lower. Now this is increasing and this is decreasing, and ultimately the level will become same, it will become same. And so is also a relevance approach, which says that capital structures are not important for decision making with a basic two assumptions. There are no taxes and investors are rational. Right? And we have understood some concept of considering taxes also. There are two things what says and that we have proved in previous lecture. Number one, if there are taxes, then value of a levered firm. What is levered firm? Having debt proportion will be equal to value of unlevered firm. Normally these both are equal, but if there are no taxes, now we are assuming there are taxes, then it will be plus debt multiplied by tax rate. Tax benefit on debt will be nothing but value of levered firm. And second, KE, this will work even if there are no taxes, even if there are taxes, right? KE is equal to KO, or it is even KE of unlevered, because for unlevered, KE and KO are same. This is KE of levered plus debt upon equity upon KO minus KD. I will be getting cost of equity, and in previous session I have found it out by the normal formula, that is earnings available to equity shareholders divided by value of equity, and then proved that by this formula also KE will remain same, and so we can summarize that this is the correct formula for KE. One of the students asked me today, and it is an excellent question, that sir, normally value of levered firm is equal to value of unlevered firm if there are no taxes. But if there are taxes, the tax benefit is always on interest. And so here we should calculate plus debt, no, interest multiplied by tax benefit, because the tax benefit is on expenditure and it is not on a value of debt. So this is an excellent question. Let me answer this. Try to concentrate. Whenever you are learning something, you need to understand there is a difference between profits and valuations. So if I want to find out the profit of Reliance, it might be 100 crore. But the value of Reliance might be 1 lakh crores. Right? So you cannot say if the Reliance is earning 100 crore rupees per annum, the valuation of Reliance is 100 crore rupees per annum. Then sir, how to value it? We know valuation in finance. It is present value of future cash flows. It is present value of future cash flows. So whenever you want to convert your profits or cash flow into valuation, you will have to divide it by something. Say, I am assuming Reliance is having a KE of 10%. What will be valuation? 100 crore rupees. See, 100 crores are profits. 1000 crore is valuation. All right. What we are doing? Valuation. We cannot take income or expenditure over here. If you say me tax benefit is my income. So you cannot directly take tax benefit over here. How to find out tax benefit? You are absolutely all right. It is interest multiplied by tax rate is nothing but tax benefit. All right. But it is a tax benefit per annum. It is not valuation. So what should be done as you are valuing debentures? It should be divided by some rate of return, in this case KD. So if you summarize this answer, this will be valuation, agreed. Right. So what is interest divided by KD? Interest divided by KD is debt multiplied by tax rate. Will be nothing but answer of valuation. Try to understand once again. If you take interest multiplied by tax rate over here, you are considering tax benefit for 1 year and you are not finding out value for 1 year. You are finding out value of the company. How to value anything? Present value of infinite cash flow divided by KD. So here it is divided by KD, and interest divided by KD is what? Interest divided by KD is debt multiplied by tax rate is nothing but increase in value. Because of tax benefit every year, this will be the increase in value of the firm. This is value of unlevered. This is value of levered. Vinny, is this all right for you?
That's very good.
Yes.
Thank you.
Okay. This was excellent question. So let us go to some questions of capital structure. This is C2.1.1. Y Limited requires 50 lakhs rupees for new project. I told you in capital structure, you will be given total finance limit required always. If this figure is not given, then it is not a question of capital structure. This project is expected to yield earning before interest and tax, EBIT of 10 lakh rupees. While decision about the financial plan, the company considers the objective of maximizing EPS. See, a good question. Even in capital structure decision, they are telling you that our objective is to maximize EPS. It has two alternative finance for the project: by raising debt of rupees 5 lakhs or rupees 20 lakhs, and the balance in each case by issuing equity shares. The company's share is currently selling at 300, but is expected to decline to 250 in the case the funds are borrowed in excess of 20 lakhs. The funds can be borrowed at the rate of 12% up to rupees 5 lakhs and 10% over and above rupees 5 lakhs. The tax rate applicable to the company is 25%. Which form of financing should company choose? Now the KD is not directly available. Try to concentrate. The funds can be borrowed at the rate of 12% and 10%. So you'll have to find out the average. But which form of financing should company choose? First, I am writing the answer which is expected to from you to be written down in examination. Let us write down both the plans. Plan 2 alternative finance of the project. So plan name is not given. Let me say it is plan A and plan. What will be total capital required? 50 lakhs. Maximizing EPS, it has two alternatives. By raising 5 lakh rupees debt in plan number 1. Debt proportion will be 5 lakh rupees. And in second plan will be 20 lakhs rupees. What will be equity proportion? Balancing figure 45 lakhs. 30 lakhs. Not given in the question, but I am writing it down. Which plan is more risky? This is having a higher debt. So plan B is risky. Plan A is less risky. In each case, by issuing equity shares, the company's share is currently selling at 300. What is MPS? 300 rupees. And here it's saying something. But is expected to decline to 250 in the case the funds are borrowed in excess of 20 lakhs. Which fund? Debt fund are borrowed in excess of 20 lakhs. The required rate of return of equity shareholders will increase. The company is not increasing its return, so the market price will fall down to 250. But we are not borrowing debt in excess of 20 lakhs in any case. What by debt we are borrowing in plan B? 20 lakhs. So what should we consider over here? 300 rupees. Let me even see the suggested whether they have done the same thing or not. Because the question clearly says if it is in excess of 20 lakhs rupees. Yes, they have also taken 300. Sir, if they have written in excess of 15 lakhs rupees, I'll be taking 250 over here and not 300 over here. Right? In this case, it is clearly written in excess of funds are borrowed in excess of 20 lakhs. These funds are always debt. If you increase the debt proportion, then only your equity price will decrease. The funds can be borrowed at the rate of 12% up to 5 lakhs and 10% over rupees 5 lakhs. Here I am borrowing 5 lakhs rupees. Let me find out interest answer. In first case, it is a 5 lakh into 12%. 60,000 rupees. In second case, I am borrowing 20 lakhs rupees. So in second case, first 5 lakhs will be 12%, which is 60,000, and remaining 15 lakhs will be at the rate of 10%, which is written at 10% over rupees of 5 lakhs, which will be 1 lakh 50,000. So total interest will be 2 lakh 10,000 rupees in case number 2. Now, many a times when I solve this question, student ask me, and this is a valid question. Sir, the sentence says at 10% over rupees 5 lakhs. This also means if I borrow 6 lakhs rupees, 10% will be on 6 lakhs rupees total and not on 1 lakh rupees. See, if you go to a bank will never say that on first 5 lakhs rupees we will charge 12%, remaining we will charge 10%. So if you are borrowing more than 5 lakhs, your interest rate will be 10%. This can be your interpretation, which is a correct assumption, correct interpretation, even as per the language. 10% over rupees 5 lakhs. What does it mean? If you are borrowing 10 lakhs rupees, a 10% on 10 lakhs will be levied as interest. If you are borrowing 6 lakhs rupees, 10% on 6 lakhs will be levied as interest. We have interpreted otherwise. How we have interpreted? On first 5 lakhs rupees, we are charging 12%. On remaining amount, we are charging 10%. Both assumptions are correct and valid. The fund can be borrowed at 12%, 5%. This we have done. The applicable tax rate is 25%. So taxes are 25%. What is EBIT? EBIT is 10 lakhs rupees. I can prepare the profitability statement of this company. Company's name is given Y Limited. So I can prepare profitability statement of Y Limited under plan A, under plan. What will be EBIT? Plan A 10 lakhs, plan B also 10 lakhs rupees. It does not change. If it changes, you cannot take capital structure decision. Which capital structure is better, plan A or plan B? Minus interest. What is interest under first is 60,000. Plan B is a 2 lakh 10,000. This will be 9 lakh 40,000 will be EBT. This will be 7 lakh 90,000 minus taxes. Taxes are 25%. I can directly find out EAT. Sir, can I do this in examination? Yes. EAT is always EBT into 1 minus T. What is EBT? 9 lakh 40,000 into 1 minus T into 0.75, 7 lakh 5,000. Sir, if I keep this blank in examination, it will do. The answer is yes. 7 lakh 90,000 into 75%. If 25% is taxation, earning after tax will be 75%. 7 lakh 90,000 into 75%, which is 10 lakh 53,333. Again, 7 lakh 90,000 into 0.75, 5 lakh 92,500. There is no preference dividend, so this is earnings available to equity shareholders. If this is earnings available to equity shareholders, let me find out N. How to find out N? I can easily do it. How much I need to borrow from equity? 45 lakhs. What is market price per share? 300. Then how many number of shares are to be issued in plan 1? 45 lakhs divided by 300. 45 lakhs divided by 300, which are 15,000 number of shares. Here it will be 30 lakhs divided by 300. Which will be 10,000 number of shares. So number of shares are 15,000, 10,000. I will be getting answer of EPS, and our objective is to maximize EPS. 7 lakh 5,000 divided by 15,000. So it is 47 per share, and this will be 59.25 rupees per share. What is our objective? Is to maximize EPS, and it is higher in plan number 2, which is more risky, and so I should opt for a capital structure. See what a decision is taken. I should go for plan B, and so my capital structure should be 20:30. That is 40:60. This should be my capital structure. I should borrow 20 lakhs rupees from debt and 30 lakhs rupees from equity. And this should be your answer. In conclusion also, you should write it down. You should opt for more risky plan. Try to understand the difference between a person who can solve the question and the person who can understand the question. Even after getting the answer, you should invest 2, 3, 5 minutes on the question to understand the concept. What is R in this case? What is R? EBIT upon capital employed, and believe me, under both plan it will remain same. Why it will remain same under both the plan? Because EBIT is also same and total capital employed is also same. EBIT is a 10 lakhs. Capital employed is 50 lakhs. R is the 20%. All right. What is cost of debt before tax in this case? Sir, there are two rates, 10% or 12%. Take a conservatism approach. Say KD is 12%. All right. It will be between 10 and 12. In plan number 2, it will be between 10 and 12, but it will not be greater than 12. So KD maximum is 12%. Still, R is greater than KD. So there is a favorable leverage. So trading on equity will work. So what you should do? You should increase debt proportion in capital structure. What does it mean? You should always select higher risky plan. And this could have been my answer of this, but sadly you will not be getting marks for this. Believe me, this is a better answer than this. This is a calculative answer. You have just calculated it. Anyone can know this. This can be known only by the student who really know the concept of trading on equity, how this works and how the capital structure decisions are practically actually taken. So if someone asks me, sir, should I still increase the debt proportion? This is 20 lakhs, right? Sir, if possible, if bank is ready to give me, should I make it 40 lakhs? The answer is yes, because trading on equity will still work. Trading on equity will still work. Why? There is a favorable leverage, and favorable leverage says increase the risk as much as possible because your risk is on your side. It is on favorable side. I expect all the students in the classroom to do this also. Write down this answer in your examination. Try to write down this answer in one line. As R, which is the 20%, is greater than KD, which is maximum 12%, there is a favorable financial leverage. Higher risky plan will always be selected, and in our answer also it is a higher risky plan. See which plan is selected? Plan B. Plan B is having higher risk as compared to plan A. Still, if you will select plan C, which is having a higher risk, higher debt, that will be selected because there is a favorable financial leverage. You should write down this in examination. We are going to next question. 2.2.3. See, I have seen 8 to 10 questions of this particular selecting plan 1, plan 2. They all are similar questions. There is just working which is going on. They find out EPS, maximum MPS, compare EPS and MPS, they select which is maximum, and this is how all the question goes in that particular case. We are going to next question, that is 2.2.3. Sun Limited is considering 2 financial plans, details of which are as under. Funds are required 100 lakhs. Plan 1, 100% equity, 0% debt. Plan 2, 25% equity, 75%. This is less risky or no, not risky. And this is risky plan. Cost of debt is 12% per annum. Tax rate is 30%. Equity shares are of rupees 10 each. Issued at a premium of rupees 25. So what is market price of share is, or issue price of the share is 25 rupees. Expected EBIT is 40 lakhs. Now if plan changes, EBIT is going to remain same. You are required to compute EPS of each plan. Plan 1, plan 2, EBIT, expected EBIT is 40 lakhs. 40 lakhs, those are rupees. Minus interest. What will be interest in each case? That will be relevant. This is plan 1, this is plan 2. Total capital is 100 lakhs. In this also it is 100 lakhs. Here equity and debt. Equity will be 100 lakhs. Debt will be 0. In plan 2, equity will be 25%. That is 25 lakhs and debt will be 75 lakhs. Interest in plan 1 will be 0. In plan 2, it will be 75 lakhs into 12%. Which is 9 lakhs. Interest will be 9 lakh rupees. I will get answer of EBT 40 lakhs rupees. 30 minus taxes. Taxes are 30%. And so earning after tax will be 70%. 31 lakh into 70%. 21 lakh 70,000. Is there any preference dividend? No. Then I'll have to find out the number of shares. Number of shares, total capital is 100 lakhs and market price of the share is 25. So number of shares will be 100 lakh divided by 25, which is 4 lakh shares. And here, thus, here 25 lakhs divided by 25, which will be 1 lakh number of shares. What will be EPS? EPS will be 7. This will be 2.17. It will be 21.70. Here it will be 7. You are required to compute EPS in each case that we have done. Find out financial break-even point. Is there one plan or two plan? Two plan. So we will have to find out financial break-even point for both the plans. Financial break-even point is equal to interest. Here interest is 0. Preference dividend is not there. So it will be 0. Your financial break-even point is equal to interest, which is 9 lakhs rupees. Those who have forgotten, it is interest plus preference dividend upon 1 minus T. So financial break-even point in plan 1 is 0 and plan 2 is 9 lakhs rupees. Find out indifference point between plan 1 and plan 2. Indifference point. X is equal to EBIT. Level of EBIT at which EPS is 0. Sorry, EPS is equal. Level of EBIT at which EPS is equal. I am finding out EPS of plan 1. What will be EPS of plan 1? X minus 0 multiplied by 1 minus T, which is 0.70, minus preference dividend. There is no preference dividend, divided by number of shares. Number of shares are 4 lakhs rupees. What is EPS of plan 2? X minus interest 9 lakhs rupees. Sir, instead of X, we cannot take 40 lakhs rupees. No. At 40 lakhs rupees, EPS is not same. You want to find out level of EBIT at which EPS is same. Minus, into 1 minus T, which is 0.70. I am directly writing down 1 minus T, divided by number of shares, which is 1 lakh. This will remain 4. This will be 0.70x divided by 4 is equal to 0.70x minus 6 lakh 30,000. 0.7 divided by 4, I can do it. 0.175 x. This I am taking on the side, 6 lakh 30,000. This will be 0.7x minus this. So this will be 0.70 minus 0.1175, 0.525. 6 lakh 30,000 divided by 0.525, which is 12 lakhs rupees. So at EBIT of rupees 12 lakhs, EPS under plan 1 and plan 2 is equal. If you are having good time in examination, you can also verify. Take this as 12 lakhs. Take this as 12 lakhs. Find out EPS. EPS should be same. I am not saying it should be 0. It should be same. So EPS under both cases should come same. This is EBIT EPS indifference point. Let us also understand EBIT EPS indifference point, which is not required in answer in examination, but let us try to just have a look on it. If my EBIT starts from 0, this is EBIT EPS indifference point, which is 12 lakhs rupees. If your expected EBIT is over here, you should go for risky plan. Say in this case, what was your expected EBIT? 40 lakhs, which is greater than EBIT EPS indifference point? Yes. Then believe me, risky plan will always be selected. Plan B is a risky plan. Plan 2 is a risky plan. And if your expected EBIT is less than 12 lakhs rupees, say your expected EBIT is 12 lakhs, you should go for less risky plan, which is plan 1. This is understanding of EBIT EPS indifference point, which is not asked in this particular question, but you should be having a knowledge. So this is 40 lakhs. Which plan is selected? Plan 2 if you go for EPS. Financial break-even point. What was financial break-even point? 0 for plan 1. What was financial break-even point for second plan is 9 lakhs rupees. So if your expected EBIT is less than 9 lakhs and you go for plan 2, your EPS will be negative EPS. This is question of a financial break-even point, also EBIT EPS indifference point. 2.2.5. This is an excellent question asked probably 2 times in recent times, only from 2018 to 2022. It is asked couple of times. Xylo Limited is considering 2 alternative financing plan as follows. Equity share of rupees 10 each 8 lakh rupees. So these are 80,000 equity share of rupees 10. These are also 80,000 equity share of rupees 10. Preference shares of rupees 100 each is only in plan B, which is 4 lakh rupees. So preference dividend rate is not given. 12% debenture is only in plan A. The indifference point between the plan is 4,80,000. What does this mean? At EBIT of rupees 4,80,000, the EPS will be equal under plan A and plan B. Corporate tax rate is 30%. Calculate the rate of dividend on preference shares. So the question is this: more of mathematics, less of finance. Try to understand how we find out indifference point in plan A and plan B, and then we equalize it. Let me take a new page. Plan A, I am finding out EPS, which is X, where X is indifference point, EBIT EPS indifference point, minus interest into 1 minus T minus preference dividend. But I don't think preference dividend is in plan number A. Plan number A, preference dividend is 0. Minus preference dividend upon number of shares. What is EPS in plan B? Same, X minus interest of plan B, plan 2, into 1 minus T minus preference dividend upon number of shares. Plan A, what is X? EBIT EPS indifference point, which is already given in the question, which is 4,80,000. Minus, what will be interest in plan A? 4 lakh into 12%. 48,000. Into 1 minus T, I have explained you, if the tax rate is 30%, after tax will be 70%, multiplied by 0.70, minus preference dividend is not there in plan A, divided by number of shares. 8 lakh divided by 10 is 80,000 rupees. 80,000 number of shares. Plan B, again 4,80,000, because EBIT EPS indifference point I already know. Interest in second plan is 0. There is no debenture in second plan. So minus 0 into 0.70 minus preference dividend is not available upon N2. N2 is also 8 lakh divided by 10, which is 80,000 number of. There is only one variable in the equation, which is preference dividend. I can easily find out preference dividend. This will be 4,80,000 minus 48,000 into 0.7, which is 3,02,400. This will be 4,80,000 multiplied by 0.7, 3,36,000. So preference dividend will be 3,36,000 minus 3,02,000, 33,600. This is in rupees. They want rate. How much you have borrowed from preference shares? 4 lakhs. Preference dividend is 33,600 rupees. So rate of preference dividend will be 33,600 divided by 4 lakhs multiplied by. This is 8.4%. What is 8.4%? It is rate on preference dividend. This is nothing but Many of the times this type of problem solving questions are asked rather than the concept of finance. This is just one preference dividend is not given. What is already given is EBIT, EPS in difference point, and we can solve the answer. We are going to some questions of capital structure theories. First is C 2.3.2. Alpha Limited and Beta Limited are identical except for capital structure. Then only we can compare these two companies. If they are identical and only their capital structure is different. Alpha and Beta. Alpha has a 50% debt and 50% equity. Whereas Beta has a 20% debt and 80% equity. So this is more risky, this is less risky. All the percentage are in market value terms. The borrowing rate for both the companies is 8%. KD is 8%, 8%. In a no tax world, and the capital markets are assumed to be perfect. This is, they are suggesting you are following Modi Giuliani Miller. If you own 2% of stock of Alpha Limited, what is your return if the company has a net operating income of 3,60,000? So EBIT is rupees 3,60,000 for both, believe me. Why? They are identical in all respect except capital structure. And the overall capitalization rate KO of Alpha is 18%. What is the implied required rate of return on equity for Alpha Limited and for Beta Limited? We'll be finding out. Beta has the same net operating income as Alpha. What is the implied required equity rate of Beta? Why does it differ from Alpha? So what they are asking us, if both the companies are same in all the respect except capital structure, they are telling us to find out KE and then they are telling us to comment that why they are different. They will be different because we will be following net operating income or approach. Let me first start with Alpha, Beta, EBIT. What will be EBIT in Alpha? 3,60,000. EBIT in Beta will be also 3,60,000. I am finding out KE for both the companies minus interest. How I will find out interest? That is a difficult thing. I can find it out. How understand? I can find out value of a firm. How to find out value of firm? I can do EBIT upon KO. This is one of the formula for finding out value of the firm. So what is EBIT? 3,60,000 divided by KO, which is available, 18%. And please understand, net operating income and Modi Giuliani Miller both says that KO will remain same whether it is levered or unlevered company. It does not change. So I can take KO in both the cases, which is 18%. So 3,60,000 into 18%, divided by 18%. 3,60,000 divided by 18%, which is 20 lakhs rupees. Is value of firm. So value of Alpha and Beta is 20 lakhs rupees both, because KO of both the company will remain same. Assumes no taxes, markets are rational, both the firm levered or unlevered will remain same. What will be value of equity? Here it is clearly given 50-50%. So 10 lakh equity, value of debt 10 lakhs. Value of debt 20% will be 4 lakhs. Value of equity 80% 16 lakhs. So I am getting that answer. Value of debt, market value and face value are always same. Cost of debt I am knowing. I can find out interest. Interest is 8% on 10 lakhs. 8% on 10 lakhs will be your interest. That is 80,000. Here 8% on 4 lakhs, which is 32,000. This will be 2,80,000. This will be 3,28,000. This will be EBT minus taxes. I will be getting EAT. I always do EAT directly. What are taxes? There are no taxes. In no tax world, this will be earnings available to equity shareholders. 2,80,000, 3,28,000. Once I am having value of equity and earnings available to equity shareholders, I can easily find out KE. How to find out KE? Earnings available to equity shareholders divided by value of equity. So in Alpha Limited, what is earnings available to equity shareholders? 2,80,000 divided by what is value of equity is 10 lakhs. In Beta Limited, it is 3,28,000 divided by value of equity is 16 lakhs. Multiplied by 100, of course, I will be getting answer of KE. 2,80,000 divided by 10 lakhs, which is 28%. This is 3,28,000 divided by 16 lakhs, 20.5%. And they are telling us to suggest why the KE is different. Why? They have written they are identical in all aspects except capital structure. Why? Because net operating income and Modigliani-Miller approach says, as you will increase your risk, the required rate of return of equity shareholders will increase. If required rate of return of equity shareholders increase, they will expect more. Which is more risky? Alpha is more risky. What is required rate of return of equity shareholders in Alpha? 28%. What is required rate of return of equity shareholders in Beta? 25.5%, because the risk is different. All right. So answer number 1 says KE is different because risk is different. They are also telling me to find out one more answer. Implied equity rate of return we have found out. Why does it differ from alpha? We have found out. Implied rate of return. If you own 2% stock of alpha, what is your return if a company has a net operating profit of 3,60,000? All right. What total number of equity share of alpha are earning? We need to concentrate. Right now we are not talking about valuation. We are talking about earnings. So we will be taking earnings of 1 year. What is 100% shareholders earning in this company? 2,80,000. So if you are 100% shareholders, you will be earning, which are available to equity shareholders, is 2,80,000. You are 2% owner. So 2,80,000 into practically 2%. So 5,600 rupees. 5,600 will be earnings of your 2% shares. This is also one of the question which is asked in this particular question of 2.3.2, and we have answered everything. If you are owning 2% stock, what will be your earnings? What is KE in both the cases? Why the KE is different? This was 2.3.2. We are going to 2.3.3. ABC Limited adopts constant weighted average cost approach When this word is written, it is nothing but NOI or MM. Both says your KO remains the same. So it is also termed as constant KO approach or constant weighted average cost of capital approach. What is weighted average cost of capital? KO. And believes that its cost of debt and overall cost of capital is 9% and 12%. KD is 9% and KO is 12%. If the ratio of market value of debt to market value of equity, so debt upon equity is 0.80, what rate of return do equity shareholders earn? Assume there are no taxes. Even if there were taxes, KE formula remains same. They are asking us question, what is KE? We can easily solve it. MM given concept of KE, which we have proved it in previous session. I am taking right now formula, but this formula we have proved it by finding out KE by earnings available to equity shareholders divided by value of equity. We found out KE and then we compared it with this formula, KO plus debt upon equity upon K multiplied by KO minus KD. What is KO in this case? 12%. What is debt upon equity? 0.80. What is KO? 12% minus KD is 9%. So this is 2.4. This will be 14%. What will be KE? 14.4%. What will be KO? 12%. What will be KD? 9%. See, KD is 9%, KE is 14.4%, and so weighted average cost of capital will be 12%. This is C 2.3.3. Before going further, let us understand Modi Giuliani Miller in detail. When there will be a tax scenario, when there will be a no tax scenario. Let us understand first no taxes environment. The formulas that we have already done will be useful and is directly applicable over here. A limited, B limited. Similar type of companies. This is unlevered. This is levered company. EBIT of A limited is 100. Whenever we are discussing capital structure, we will take always a similar type of company having different capital structure. Minus interest will be 0. Here the interest is 10 rupees. 100 rupees a debt at the rate of 10%. My earning before tax will be 190 minus taxes are 0 because we are working in no tax environment. I will be getting earnings available to equity shareholders or earning after tax. 100 rupees, 90 rupees. Please understand, unlevered company KO is say 12%. So KE will also be 12%. Why KE will be 12%? Because in this company there is no debt. Interest is 0. So KO, overall cost of capital, there is only one source of capital which is equity. So KE will be 12%. What will be value of a firm? Can we use the formula earnings of EBIT divided by KO? Yes. If there are no taxes, this formula can be used. KO is equal to EBIT upon value of firm. So value of firm is equal to EBIT upon KO. So EBIT is 100 and KO is 12%. So 100 divided by 12%. 833.33. This is nothing but value of firm. What will be value of equity? 833.33. And what will be value of debt? 0. There is no debt. A Limited is unlevered company. It is not having any debt. Try to understand. Modi Giuliani Miller assumes no taxes, and the theorem says, theory says that value of a firm remains the same irrespective of your capital structure. EBIT of both the companies is same. Capital structure is different, but it will not affect the value of the firm. So value of the firm in levered company will remain 833.33. Value of equity can be found out by value of firm minus value of debt. And what is value of debt? 100 rupees. So value of equity will be 733.33. Can I find out KE? The answer is yes. How to find out KE? Also KO will remain same, right? Which will be 12%. But KE should change. The cost of equity will change. What will become cost of equity? Try to understand. How I can find out? It is earnings available to equity shareholders divided by value of equity, which is earnings available to equity shareholders is 90. Value of equity is 733.33. 90 divided by 733.33, which is 12.27. Sir, can I find out the same answer by the KE formula given by Modi Giuliani Miller? The answer is yes. KE of a levered firm is equal to KO of unlevered firm or KE of unlevered firm plus debt upon equity into KO minus KD. Let me find out the answer. KO of unlevered or KE of unlevered is 12% plus debt. What is debt? 100 upon equity 733.33. KO minus KD is the 12% minus 10%. What will be the answer? 100 divided by 733.33 multiplied by 2 plus 12, which is 12.27%. Which is 12.27%. Which is the same as how we have found out in this manner, right? Also, what Modi Giuliani Miller says, value of firm unlevered will be is equal to value of firm which is levered. So only we have taken this answer as same. When there are no taxes, answers are easy. Why? You can find out KO by this method. How to find out KO? Try to understand. KO is equal to, I can directly take EBIT upon value of firm. In the levered firm, EBIT is 100. Value of a firm is 833.33. Answer will be 12%. We have taken same value of same KO. That is the same reason, or you can find out KO in this manner also. Sir, KO in cost of capital we were finding out by sigma IW, sigma W. You can do the same thing. Equity is costing you 12.27. Debt is costing you 10%. The weights are 100 and 833.33. These are I, these are W. We can find out the answer. Let us go to our weighted average Excel sheet and find out the answer. 12.27. What is the weight for equity is 833.33. So this will be 833.33. Cost of debt is 10, weight is 100 and 12.02. So there is a rounding of error. Ultimately, the answer is 12%. Sigma IW divided by sigma W, answer is 12%. So when there are no taxes, try to understand which formulas we can use, which formula we cannot use. Value of equity is earnings available to equity shareholders divided by KE, or KE is equal to earnings available to equity shareholders divided by value of equity. Value of debt is equal to interest divided by KD. And value of firm, we can use this formula, which is EBIT upon K. Also, value of firm is always equal to value of equity plus value of debt. As far as Modi Giuliani Miller is concerned, value of unlevered firm will be is equal to value of levered firm. In our case, value of A Limited and B Limited is same. KE can also be found out by KO. KE, we will be getting answer of levered firm. KO should be taken of unlevered, or KE of unlevered will be same, plus debt upon equity upon KO minus K. You will be getting answer of KE. All the formulas can be used when there are no taxes. Try to understand the concept when there are taxes and the situation. Suppose for the same companies, now the taxes are applicable. Same companies, A Limited, B Limited. Still they are earning, this is unlevered, this is levered. Still they are earning same EBIT. 100, 100. Minus interest, unlevered 0, levered is paying 10, 100 rupees multiplied by 10% interest rate. This is 100, this is 90. Minus taxes are 30%. So this is 30, this is 27. Earnings available to equity shareholders. This is 70. This is 60. Let us first understand unlevered company. Try to concentrate KE. First let me write down KO is equal to 12% of unlevered. So KE will be also is equal to 12%. Sir, can I use this value of firm is equal to EBIT upon KO? The answer is no. When there are taxes, this formula cannot be used. This can be used if there are no taxes, but it cannot be used when the taxes are applicable. Why? I tell you a simple thing. It is not earning before interest. It is earning before interest and taxes. So taxes are yet to be deducted. So this profit is not only available to equity shareholders and debenture holders. This profit is available to equity shareholders, debenture holders, as well as government in form of taxes. So this cannot be used when the taxes are applicable. We can formulate the formula, but we can use this. Value of equity is EAT, or earnings available to equity shareholders, divided by KE. Why? This figure is available exclusively to equity shareholders. This profit is not available to government. This profit is not available to interest holders or debenture holders. This profit is purely and purely available to equity shareholders. I can use this profit. Whether there are taxes or no taxes, this profit, 70 rupees, will be available to equity shareholders, and I can find out value of equity. Value of equity will be 70 divided by 12%, which is 583.33. So value of a firm is 583.33 because this firm is only having equity. Value of debt in this case is 0. Sir, value of firm should be equal to EBIT upon KO. What is EBIT? 100 upon KO, 12%. No. Again, remember, this formula cannot be used when the taxes are there, because EBIT is not only available to debenture holders and equity shareholders, this profit is also available to government. So let me rub this. We have already written this. All right. Let us go to B Limited, which is levered form. Try to understand. Even Modi Giuliani Miller does not say this will be 12%. He says KO will remain same only if there are no taxes. So I cannot write down 12% over here. Let me rub it. KE never remains same. Even in no taxes scenario, KE is changing. Value of equity will not remain same. Value of a firm. This is how explains. Value of a levered firm is equal to value of unlevered firm if no taxes are applicable. If taxes are applicable, debt into tax rate will be added. What is value of unlevered firm? Value of unlevered firm is 583.33 plus debt is 100 multiplied by 30%. This is 30, so it will be 613.33. Value of firm will be 613.33. There is no other way to find out value of levered firm directly from value of unlevered firm. So if the two companies are same, one is unlevered and levered, both are in tax zone, value of levered firm by Modi Giuliani Miller can be found out, and it will be 613.33. What is value of debt? 100. What will be value of equity? It will be 513.33. What will be KE? It is interesting to understand. Try to concentrate. Value of KE is found out by earnings available to equity shareholders divided by value of equity. Sir, can this formula be used? The answer is yes. We have used this formula and found out this. So even if the taxes are applicable, then this formula can be used. Sir, logic? Logic is earnings available to equity shareholders is exclusively available to equity shareholders. No government intervention is there in this profit. 70. Government is already paid. This 30 rupees is already paid, and then we have got the answer of 70. So there will not be any change. We can use this formula. Earnings available to equity shareholders are 63 divided by value of equity is 513.33. 63 divided by 513.33. It is a 12.27%. Let me compare it with a scenario of no taxes. In no taxes also, this firm, which was a levered firm, similar firm without a taxes, 100 rupees a debt at the rate of 10%. The cost of equity was 12.27%. When there are taxes, cost of equity is still remaining 12.27%. What is the reason? Try to understand. Whether there are taxes or no taxes, equity shareholders, dividend are not liable for taxes if you see from the point of view of the company. So required rate of return of equity shareholders will not be dependent whether the company is liable to pay tax or not. Say I am investing in A Limited, I am investing in B Limited. If I invest 100 rupees in A Limited, I want 10 rupees. If I am investing in B Limited, I want 10 rupees. My required rate of return is 10%. Now, whether this company is liable to pay tax and this company is not liable to pay tax, I am not concerned. If they are liable to pay tax, after tax, they should give me 10 rupees. If they are not liable to pay tax, before tax, they need to pay me 10 rupees. But required rate of return is going to of equity shareholders in taxable company and non-taxable company is going to remain same. There will not be any change as far as required rate of return of equity shareholders is concerned. This is the reason KE is remaining same. Okay, then let us use that alternate formula also, where KE of a levered firm is equal to KO of unlevered firm plus debt upon equity multiplied by KO minus KD. KO of unlevered firm is 12% plus debt upon equity. What is debt? 100. Equity is 513.33. This is 100 divided by 513.33. Into bracket 12% minus 10%. What answer I'll be getting? I will be getting 100 divided by 513.33 multiplied by 2 plus 12, which is 12.39. Which is correct or not correct? What is the correct answer? 12.27. So this is not a correct answer. Why it is not a correct answer? Try to concentrate with previous one. The answer is going to remain same. So the figures over here should remain same. Is this 12%? Yes. Is this 100? Yes. Is this 733.33? The answer is no. Others are same, 12% and 10%. But this figure is not same. Why? Value of equity has decreased. See, KE has not decreased. No? Value of equity has decreased and value of equity should decrease. Why? Previously we were getting 100 rupees. Now we are getting only 70 rupees. So value of equity should decrease. Previously here we were getting 90 rupees. And in B Limited, we are getting only 63 rupees. So the value of equity should decrease because some portion is taken by government. But the required rate of return of equity shareholders will not increase or decrease. It will remain same. That is 12.27. But mathematically, if you see, this figure is 733.33. This figure is 513.33. We will not be getting same answer. KE should remain same as of no taxes. Try to understand what we do. We will multiply 1 minus T over here. What is 1 minus t in our case? 0.70. So that into 1 minus t, I will be writing in numerator, denominator it will be equity. Please understand this 513. Let us compare with the previous figure. What should be figure over there? 733.33. 733.33. What was value of equity when we were having no taxation? 733.33. What was value of equity when there was no taxation of B Limited? 733.33. If the tax comes into picture, the value of equity will become 70%. The value of equity will become 70% because some of the portion is taken by government. What is the answer? 733.33 multiplied by 0.7 is 513.33. Is it? Because of taxes, this is already multiplied by 70%. So in numerator, we will have to multiply by 70% if we want same answer. And we know that cost of equity is going to remain same. So what I do here, multiplied by 70% has already happened because you have come in tax era. In numerator, I'll be multiplying it by 70%. I will be getting correct answer. Let's try to find out. 12% plus this is 70 rupees divided by 513.33 into 2%. Answer will be 12.27%. Let me also verify. 70 divided by 513.33 multiplied by 2 plus 12, which is 12.27%. So KE, you will have to change somewhat the formula to find out correct answer of KE. See, I advise, if earnings available to equity shareholders is there, if value of equity is there, you should directly do value of equity divided, earnings available to equity shareholders divided by value of equity. Directly you will be getting answer of 12.27. But here I am finding out in an alternate manner also. I'm finding out in an alternate manner also. Alright, so I have got KE. Now understand KO. Can I do this? EBIT upon value of a firm 613.33. The answer is no. This cannot be used if the taxes are there. This EBIT is inclusive of taxes and hence we will not be getting a correct answer. Then how to find out the correct answer? We are having equity cost. We are having debt cost. We will be having weight. Cost of equity is 12.27, but cost of debt is 7%. Equity is valued at 513.33 and debt is valued at 100. This is I. This is I. This is W. Do sigma IW divided by sigma W. Let me use this. This is 12.27. Debt is 7. This is equity is 513.33. And debt is 100. What will be KO or overall cost of capital is 11.41%. It will be 11.41%. So this will be KO. Here I am writing it down. KO 11.41%. See, even in Modigliani Miller, KO is changing because assumes no taxes and here there are taxes and so KO will reduce. Even value of a firm is increasing. As per this formula, value of firm is increasing. KO will decrease, value of firm will increase, KE will remain same whether there are taxes or whether there are no taxes. It does not make any difference. Sir, this 11.41 I will get answer by EBIT divided by 613.33. The answer is no. The answer is no. Why? In EBIT there are taxes. In EBIT there are taxes. Alright. So in whenever there are taxes, I will be multiplying 1 minus t in numerator. That should be absolutely good for you all. Let me go into details of KO also. See, I have continuously told you whenever taxes are applicable, at that time you cannot use this formula. KO is equal to EBIT upon value of a firm. But we can modify it. Try to concentrate. We can do this. KO is equal to EBIT into 1 minus t. We are reducing the tax. Divided by value of firm. We will be every time getting correct answer. Let me verify. See, here I was not getting correct answer of value of firm. 100 divided by 12%, I was not getting the answer. But 100 into 1 minus t is 70. 70 divided by 12%, I will be getting answer of 583.33. Here also KO, see, I have done sigma IW divided by sigma W. But I could have done this. KO, what is EBIT in this case? 100. What is 1 minus T? 0.70. Divided by value of a firm is 613.33. This is 70 divided by 613.33, which is 11.41. Which is the same KO as we have found out over here. Are you getting it? So, this will be summary of no taxes and taxes. Let me change the color. Whenever there are no taxes, I can use this formula. Value of equity is equal to earnings available to equity shareholders divided by KE. Value of debt is equal to interest divided by KD. Value of a firm is equal to EBIT upon KO. And we can always use value of firm is equal to value of debt plus value of equity. So similarly, we can also use this formula. KE is equal to earnings available to equity shareholders divided by value of equity. And here also KO is equal to EBIT upon value of firm. If we can use this formula, we can always use this formula. They are the same formulas. For finding out KE of levered firm, we will have to use KO of unlevered plus debt upon equity into bracket KO minus K. And for value of levered firm, will be is equal to value of unlevered firm because there are no taxes. This will be the scenario if there are no taxes. If there are taxes, which formulas we can use? We can always use this formula. I have told you even the logic. Earnings available to equity shareholders does not include the portion of taxation. Now from this money you don't have to pay the tax. Divided by KE. or KE is equal to earnings available to equity shareholders divided by value of equity. Both can be used. Value of debt, it is interest divided by KD. Please understand, if you take interest which is after tax, you will have to take KD which is after tax. If you take interest before tax, you will have to take KD which is before tax. You will be getting the answer. Value of a firm is equal to EBIT upon KO cannot be used. But this can be used. EBIT into 1 minus T upon KO. So you can even use this for levered firm. Sorry, it will be both applicable for levered firm as well as levered firm. So value of firm can be found out by this. So you can use the formula KO is equal to EBIT into 1 minus T upon value of firm, and you will be getting the answer. Also, value of firm is also equal to value of equity plus value of debt. As far as KE is concerned, you will have to use KO plus debt upon equity, KO minus KD, and as we have understood in detail, we will multiply 1 minus T in numerator. Why? In denominator already equity has reduced to 70%. So you will have to reduce denominator even to 70%, or the real debt portion is after considering the tax benefit valuation. This is 1 minus T. Let me write on 1 minus T with a different color, so that you understand this is the only change, right? Also, value of levered firm will be is equal to value of unlevered firm plus, this will be added, debt multiplied by, and in this session we have understood how this debt multiplied by tax rate works, right? This is when there are no taxes. Whenever there are taxes, you can use this formula, find out the answer, you will be getting a correct answer. Let us try to solve one question, which is Modi Giuliani Miller, and now it will be extremely simple. Stopco Limited, an all equity finance company, is considering to repurchase 200 lakhs equity and replace it with 15% debentures of the same amount. So currently Stopco Limited, this is present situation. Company is Stopco Limited. It is 100% equity. And to replace it with 15, current market value of the company is 1140 lakhs. 1140 lakhs is value of equity, even value of debt is 0. So value of firm is 1140 lakhs. And its cost of capital is 20%. Its earning before interest and taxes are expected to remain same in future. Its entire earnings are distributed as dividend. Applicable tax rate is 30%. You are required to calculate the impact on the following on account of change in capital structure as per Modi Giuliani Miller model hypothesis. First, we need to find out market value of the company if we are proposing this. Try to understand. It is proposed that same company SG Limited will buy back 200 lakhs equity and convert it into debt. First it was unlevered company. Now it is planning to become a levered company. Now there will be 200 lakhs debt of 15%. That is 30 lakhs will be now onwards interest. Right. This is proposed and this is present. Let us first analyze the present situation. Try to concentrate. Present, they are saying us value of firm is 1140 lakhs. I am using the formula of value of firm is equal to earning before interest and tax into 1 minus T. We have done this. Upon KO. So value of firm will be 1140. EBIT we don't know. 1 minus T, tax rate is 30%, so it is 0.70 upon KO. And its cost of capital is the 20%. So EBIT, I will be directly getting the answer. It is 1140 into 0.20 divided by 0.70, which is 325.71. Lakhs rupees. Let me write down present scenario. EBIT 325.71 minus interest 0, earning before tax 325.71 minus taxes of 30%. So I will be getting EAT of 325.71 multiplied by 70% into 1 minus T, 227.997. This is earning after tax. Are we knowing KE? Yes, it is 100% equity. So KO is a 20% and even KE is 20%. Let us go to proposed situation. Where the value of a firm will change, but what will remain same is EBIT. What is EBIT? 325.71. You are not changing the business. You are not changing anything except capital structure. You are buybacking equity shares and issuing debentures. So except a change in capital structure, there is no other change. Minus interest. Now it will be 30 lakhs. Answer will be 325 minus 30 is 295.71, which will be EBT. Minus taxes will be 30%. So remaining will be 70%. 295.71 multiplied by 70%, which is 206.997. Will KO remain same? No. But I can find out value of levered firm. Value of levered firm is value of unlevered multiplied by debt into, sorry, plus debt into tax rate. What is value of unlevered firm? 1140 plus how much debt we are going to issue? 200 lakhs into tax rate, which is 30%. So it is 60. 1140 plus 60 will be 1200. This will be value of restructured stop go limited, value of levered firm. What is the value of debt in this case? 200. So what will be value of equity? Will be 1000. I can easily find out KO, I can easily find out KE. KE, I am still in proposed. KE is earnings available to equity shareholders divided by value of equity. This I can use even if there are tax rates. Earnings available to equity shareholders are 206.997 divided by value of equity is 1000. KE will be 20.7% approximately. How to find out KO? Whenever there are taxation, it is EBIT into 1 minus T upon value of a firm. I'll be getting answer. EBIT is 325.71 upon value of a firm is 1200. What will be KO? Is 325.71 divided by 1200 multiplied by 100, that is 27.14. Let us correct it. This is not 325.71. We need to do 1 minus T, right? Into 1 minus T. Multiplied by 100. Answer will be 325.71 multiplied by 0.7 divided by 1200. It is 18.99, approximately 19%. KO will be nothing but 19%. This will be the change in scenario as far as the restructured this stop go limited is concerned. What was value of a firm before? It was 1140 lakhs. Now the value of a firm, of a levered firm, is 1200. What was KE before? 20%. Now KE will be 20.70. KE will increase because the cost has increased. What was KO? 20%. Now it will be 19% because of that tax benefit which is involved and leverage which is involved. Leverage on tax benefit is involved. Value of equity has changed. That is all right. Now, for the purpose of logical understanding, sometimes they might draft the question in such a manner that you can use only that method to find it out. Can we find out KE by other method? The answer is yes. KE, whenever the tax is involved, is KO plus debt into 1 minus T upon equity, KO minus KD. Same formula, just this 1 minus T is added if there is a tax. What is KO of unlevered firm? 20%. Plus, what is debt in our case? 100? No, 200. 1 minus T is 70%. What is value of equity? 1000. KO 20%. Minus KD. Now don't take this KD after tax. We have already done this after tax. So this KD should be before tax. And what is before tax? Rate of interest on, and it is 15%. It should be taken pre-tax. This will be 200 into 70% is 140. 140 divided by 1000 multiplied by 5 plus 20. That is the 20.7%. Is the answer same? The answer is yes. Can I find out KO by other method? The answer is yes. KO can be found out by other method, which is IW. Equity is costing me 20.7. Debt is costing me 7%. Weight of equity is 1000. Weight of debt is 200. I can find out sigma IW divided by sigma W. Let me use my Excel sheet and directly find out the answer. Sigma IW divided by sigma W. What is cost of equity? Cost of equity is 20.70. So this is 20.7. And what is my cost of debt? Cost of debt is 7%. This is 7%. Value of equity is 1000. And value of debt is 200. What will be answer is 18.41. Sorry, this is 15 into 1 minus T, that is 0.7. This will be 10.5. There is a mistake. The debt is 10.5. I will be getting answer of 19%. My KO is 19% by this method. Alternate method to find out KO, sigma IW divided by sigma W. You can directly use this formula to find out KO. Very important for without the taxation, with the taxation is this chart. This should be understood at any point of time. Once you understand this, believe me, solving the questions of Modi Giuliani Miller will be a child's play. This should be all for Modi Giuliani Miller, and this is all for capital structure.